Hey everybody, I know it's been a while, but we've been really busy in our offices. We're in the middle of rebranding, getting new logos, redesigning our website, getting a new name, and we're preparing for first quarter sales and the report that goes out to hundreds of thousands of people at the least. And I'm getting ready to go on the road for quite a bit. So apologize for the delay, but I did want to spend our next few minutes anyhow discussing life insurance. Life insurance is kind of the thing that got me really passionate about this industry. My grandfather, my paternal grandfather, was a life insurance agent for many, many years. And having the opportunity to witness him and different exchanges that he had really impacted my opinion of the insurance industry. And I really feel that this is an industry with integrity. And being a life insurance agent, whether you're a man or a woman, or whether you also sell other insurance products, it's a very noble profession. So I want to take this opportunity to educate everybody pretty quickly on the difference between term and perm, or term life insurance and permanent life insurance. And this is something that really is very, very important for people to understand. Since I've become involved in the life insurance industry, I've realized that so few people actually have life insurance. And unless you have enough money that you can cover all the taxes that may be due upon your death, pay off all your debts on death, pay for all your funeral expenses, and the continuation of your income for your spouse, and all those things that go along with what would happen if I disappeared off the face of the earth. Unless you have enough cash laying around to do those things, you should have life insurance. Now, I'll tell you a little bit about term and a little bit about perm, and then we'll get into a quick discussion about which of those do I need and how much of both. And this is mostly based on my opinion. I certainly would consider myself to be an expert on products and marketing and distribution, but I need to add a little disclaimer before the beginning of this video and say that although I am a licensed life insurance agent, and I have been for more than a decade, I've never sold life insurance. So a lot of the training that people need in order to sell life insurance, I have not been through. But I go through a lot of the courses that people have to take in order to maintain their license. And those things have really helped me a lot over the years in understanding this product and its application to consumers. First of all, term life insurance is temporary life insurance. The most common types of term life insurance would be annual renewable term, what some would refer to as ART, or 10-year term, 20-year term, or 30-year term. Basically, the way that product works is you pay a stated premium amount, and we'll say in the example of 30-year term, we would pay that premium for 30 years, and we would have the amount of coverage that we selected at the time that we bought the policy for that entire 30 years. Now, at the end of the 30-year period, if the policy is renewable, the insurance company, if I'm young enough, will say, hey, Cheryl, do you want to get another 30 years? They could say, another 10 years, or they could say, well, we'll offer you 1 year at a time of coverage from there on out. If they do offer renewable term beyond the initial 30-year period, my premiums are going to go up substantially as compared to what they were when I purchased the 30-year term policy. That's because term life insurance is essentially a life insurance product where you're paying for the pure cost of what it would be for the insurance company to cover your life, and really that's just it. Above and beyond that, it's merely just a policy fee in almost all instances, and that policy fee is to pay for the insurance company's administration of applying your premium payment to the policy and sending out your billing notices. So it's not necessarily a policy where insurance companies make a ton of money on it. And you'd think, well, yeah, but a lot of term life insurance policies, no death benefit is paid. Well, that's true, but in the approximately 2% of term life insurance contracts that do have death claims paid on them, they're essentially pooling the risk with all of the term life insurance policies. And so, you're getting a large amount of insurance typically for a very little amount of premium. The thing I want to drive home here is that term life insurance is temporary. And although I might buy a 30-year term policy now, when I run out of that 30 years, I'm going to be 67 years old. And so the life insurance company at that point is going to say, there's a pretty good possibility that now that Cheryl is 67 years old and her first 30 years is up, that she's going to die sometime within the next 30-year period. Because let's face it, I'm not going to make it to 97, folks. So at that point, they are probably going to come back and say, Cheryl, we're just not going to allow you to renew that 30-year term policy. We think there's a pretty good chance you're going to die. So guess what? Your life insurance is up. You don't have any at this point. Now, it wouldn't be a huge concern if I had some perm. The problem is a lot of Americans have only term life insurance. And so if you're watching this video and you're saying, oh no, I'm not worried about it because I have life insurance through my employer. Well, guess what? Most employers pay for term life insurance for their employees. And then you also need to be concerned about the point that a lot of employers don't have portability in their life insurance policies, which means if you should leave your employer, can you take that life insurance policy with you? A lot of employers will not allow you to. And so then if you leave your employer, you might have no insurance at that point. So it's very, very important to make sure that either your policy is portable or that you have sufficient coverage of your own. And my suggestion would be, if you need life insurance, you better make sure that you have some perm in addition to your term, okay? Now here's where the perm comes in. Permanent cash value life insurance can come in many different forms, and that's beyond the scope of this video this evening because we're trying to make these segments kind of short. I don't want to lose your attention. So we have several different types of cash value life insurance, and the primary types would be whole life insurance and universal life insurance. Universal life can come in several different varieties: traditional universal life, index universal life, and then variable universal life. All of these types of insurance are permanent cash value life insurance, which means they will pay a death benefit no matter how old you are when you die. Once you buy that life insurance, if you don't die till you're 120 years old, they're still going to pay a benefit to your beneficiaries that you designate. The dilemma is that cash value life insurance is more costly than term life insurance. But that's kind of the point, because term life insurance is intended to be temporary, and permanent cash value life insurance is supposed to be, well, permanent. So it is a little more costly. And people say, well, why would I choose one versus the other? Which one's right for me? Well, I'll tell you what, permanent cash value life insurance is a staple that everybody should have. Not only does it pay a death benefit out no matter when you live or when you die, but it also builds cash values that you can use for things other than a payment upon your death. So while you're alive, your life insurance would build up internal cash values, and you might use them to take a loan against your life insurance policy, maybe for a down payment on a house, or to pay for your child's first vehicle, or to help fund your grandchild's education. There are so many different reasons. And actually, when it gets down to it, in order to take out monies against your own cash value life insurance policy, you don't have to fill out an application. You can just call the insurance company, and you don't even have to tell them what you're using it for. I've actually given a guy a loan for him to buy Super Bowl tickets. So you can get that for any purpose that you deem, and there's no application process. Now, if you're taking a loan, there is loan interest that's payable, and we'll talk about that in a later episode, but there are what's called living benefits to cash value life insurance that you can use while you're living, in addition to providing a death benefit that goes to your beneficiaries no matter when you die. And for that reason, permanent cash value life insurance is extremely valuable. I'd like to give you an example of why I think that's the case. I'm not yet 40, and yet I have a health condition that has made it so that it would be very hard for me to qualify to get life insurance. And if I did, it would be very, very cost prohibitive. I didn't know that I would eventually be diagnosed with this illness, and so I bought life insurance at a very, very young age. And it's a lucky thing that I did, because getting life insurance requires a process called underwriting, where the insurance company determines how much of a risk are you for them to offer life insurance to. What's the probability of you dying at a certain time based on your sex, your health status, the amount of insurance that you're purchasing, your lifestyle, whether you smoke or use tobacco products, and whether you don't. And I bought that life insurance just based on the understanding that I thought it was important. And it's a good thing I did, because today if I went to buy that same life insurance policy, I'd probably be turned away from the insurance company. So at least I have the peace of mind now of knowing that my children and my husband will be taken care of regardless of when I should die, because I already purchased that policy. They can't hold my health condition against me now that I've been diagnosed. So it's very, very important. Now, when people say to me, well, which one is best for me, term or perm? My response is, if you don't have enough cash to pay for all of those expenses that we talked about at the beginning of the video so that you can self-insure, you need both. Well, how do you determine how much of each you need? And this is the part where I say, this is Cheryl's opinion. I certainly have never sold insurance products, but when I look at, let's just take me as a case study. I mean, we've been doing that quite a bit anyway. I have 3 teenage children and a husband who runs his own business building houses. I also own a business, and I have 5 employees, and we've been doing pretty good. We've been in business for about 9 years, but there are certain things that I want to take care of if I were to drop off the face of the earth today. For one, I want to be buried, so I want to make sure that my funeral expenses are covered, that I can cover, you know, the cost of the casket, of the funeral, of the burial plot, of the grave marker. I also want to make sure that my kids are able to go to college without struggling to do so. I want to make sure that all of my mortgages are covered. My husband and I do real estate investing, and we have several rental properties. So I wouldn't want the burden of the mortgages on those houses to be too much if I were to pass away, that my husband would have to, you know, declare bankruptcy or something of that nature. So I'd want to make sure all those mortgages were paid off. I would also want for my income to continue even after my death, so that my husband and my children could continue to live in the house that they live in now and live the lifestyle that they have today. Not that it's, you know, some lavish lifestyle. We do live comfortably. And I'd also want to make sure that if I were to pass away today, that the charitable organizations that I feel very passionate about would be able to get some kind of legacy contribution from my death. So when I look at all those things that I want to make sure are taken care of in the event of my death, and oh, don't forget that I want somebody in my employment. I have a very special partner in crime at the office here who I think would be very capable of purchasing the business in the event that I were to die and continue doing the work that I started 9 years ago. So I want enough money so that if I were to die, the business could continue for a while, and that we could make arrangements essentially for that key person employee to buy out my share of the business, which at this point is 100%. So I'm sure there are other things I'm not thinking of, but I'm just doing this video on the fly. So those are all things I need to have taken care of. Once you identify what are all those debts, what are all those needs, what are all those things that I want to be provided for on my death, you need to essentially make 2 lists. One list is which of those things are going to be temporary needs that you'll need a financial commitment for, and then the other list is which are permanent needs. And what do I mean by that? Well, the mortgages on the properties that I have are 30-year mortgages. So at the end of 30 years, those properties will be paid off. Those would go in the temporary needs list. But making sure that my income is replaced if I were to pass away today so that my family could continue to live in the house that they live in, for example, that would be a permanent need. That need is going to exist no matter if I die today or if I die 10 years from now. So we'd put that on the permanent list. Other things that go on the temporary list would include things like paying off student loans, paying for any other types of loans that you would have. Permanent needs would include things like making sure that my business would continue, ensuring that any, grandchildren that I might have if I'm older could have their educations paid for, ensuring that my children have college expenses covered. So you break those things down and you put them into each of their respective lists. The things that are in the temporary list would be things where you need to aggregate the amounts that you need for each thing and get appropriate amount of term life insurance coverage. And typically of all those temporary needs, your mortgage is going to be the big ticket item with the longest temporary need. Normally it's a 30-year mortgage, but with interest rates being as low as they have been over the past few years, a lot of people have refinanced and moved those to 15 and 10-year mortgages. So just be aware of how long that financial commitment is and buy the appropriate amount and appropriate type of term life insurance coverage. And then for those permanent needs like income replacement, being able to take care of the business should the business owner pass away, those would be permanent needs. So you would aggregate what the amount would be that you need for each of those items on the permanent list and then purchase the appropriate amount of permanent life insurance coverage. Now, which type of permanent life insurance coverage is a whole other discussion that we'll handle in another video. But I hope now everybody has a basic understanding of term versus perm and understands that permanent life insurance is very, very important. Term life insurance coverage is absolutely not enough. And hopefully that basic information is enough that you'll be able to make a decision on, am I properly covered? Do I have coverage at all? And hopefully it'll at least get you asking some questions about the coverage that you have today. So thank you very much for tuning in, and we'll see you next time. I think next time we'll probably go more in depth on different types of cash value life insurance. So have a good evening. Thanks, everybody.